All right. Well, we're sort of also considering clearly what's going on with the Fed. That macro picture at the moment is so much to consider. Let's dive into some of that and the implications. We're joined now by Peter McGuire from XM. Pete, terrific to catch up with you midweek, and of course, lots to consider, particularly tomorrow morning when the Fed will drop its decision. Gee, who would want to be a central banker at this point? Because their job really got so much more difficult when this banking crisis emerged, didn't it?
Absolutely, Andrew. Yeah, it'd be a tough gig when you're thinking about it. Next Wharton Dean, Pat Harker from Philadelphia, he sits on their board. So you know many different viewpoints, because you've got to look at the states, and we've got to take on board it's such a vast country geographically, 320 or 330 million people, and you've got from down south all the way of Texas, then across the desert into California, off to New York City, and all the Midwest and down to Florida. So it's a massive, encompasses so much land, and as you know, there are many different viewpoints across that nation as far as what your economic health is. It's a different economic health from San Francisco versus Miami and so on. So these are the I think the views that need to be identified and appreciated from everyone's different standpoint.
All right. So the view being that they will raise rates by 25 basis points. Perhaps if they pause, that could potentially scare investors, saying, well, perhaps they realise that there's something much deeper, a deeper crisis afoot. So, Pete, how's that likely to be reflected, particularly as far as currencies are concerned?
Well, I think, David, pardon me, Andrew, I mean, when you're thinking about it, 20% probability that there'll be no action, 80% probability you'll see 25 basis points. So everything seems to be baked into that side. And where we look, Andrew, as far as, currencies, you've got that US dollar index coming under further softness at 103.21. We're conscious what's happened to gold prices. It was up $200 in 10 days, back at about 1965 now. So I think that if they don't do anything, then that would certainly weaken the dollar further. And if they do something as far as 25, it's probably baked in. It'll stay at this sort of level, 103 to 103.50, I would say. So, and the impact naturally to currencies, euro, have a look at what happens to the yen. The yen sitting at 132.6. So, I think the volatility will remain, and I think it's going to be an exciting time. You say, who wants to be a central banker? I think the traders like to take on board what's going to happen.
Well, yeah, because if you're trading that volatility, fantastic. But of course, it's not just the Fed, also the Bank of England this week as well.
Yeah, exactly right. We're keeping a close eye on the POMs, and they're a different situation over there in the sense of economic health compared to they've got very low wage growth. If it's negative over the last year or so. You've got still very, very high inflation numbers. The overall growth of the UK is far weaker than what the USA is. So there's a concern there, and how aggressive the Bank of England's going to be. You've still got that pound sitting at about 1.22 against the US dollar. So I wouldn't be surprised to see that move and move considerably, because I think that there's more bad news ahead for the pound, and that could be a little bit further softness there.
All right, we might just see if we can get that chart up for the pound. We've got a few of those we can get through, but well, there we go. Just talk us through what you're seeing there.
Well, that's a Euro/Great British pound chart.
Yep.
And I think that probably you'll see continued weakness against, strengthening for the euro, weakening for the pound. And you've seen quite dramatic move as far as opportunities over the last probably month or so with that market. So I'm not suggesting that's going to stop anytime soon. The euro is relatively strong at 107 and nearly 108, and we're conscious, European banks and so on. So it's not a bad, it's been a nice trade, the euro.
Pete, let's head to commodities. We might begin with oil. We've seen a bit of a bounce overnight, but that has been in a downward trend, obviously on those global growth concerns.
Absolutely, Andrew. I mean, it's been sold off solidly. You've got that WTI is back from 65. It's now at 69 and a quarter, 69 and 35 cents. And we've got Brent sitting just on $75 a barrel. So they've both been pushed much lower, and everyone was saying, where's the bottom in this? And it seems to have bounced. I'm not sure if it's dead cat or we've just got to wait and see what happens as far as the Fed and growth numbers for the rest of the month. But if that was the bottom, then maybe it's on an upward trend. It seems to get pushed in aggressively across, $5 and $10 moves in a week. So it's, again, incredible to trade and plenty of opportunity for traders, that one.
All right, elsewhere, gold. Goodness, we've seen a lot of volatility there recently, and today, taking a look at it, those gold stocks are off quite substantially. Of course, they received a huge boost on Monday as investors sought that safe haven in the wake of the banking crisis. But then you've seen those yields climb, the US dollar, the strength there. Is that a place you'd be happy to be at the moment?
Well, it's been incredible over the last 2 and a bit weeks because we were down at 18.10, and then all of a sudden the bank crises really started to gather a hell of a lot of momentum, with Silicon Valley and then Signature, and then it just ratcheted up from there, and Credit Suisse. So that created just mayhem across the gold market, and it put on $200. A lot of the smart money jumped in and they did extremely well, picked up $100 moves, $140 moves, and it's given up from that 2010 sort of number, given back $50. And a lot of people were short-term traders were short over that. They saw the signals come through on the technicals and they dumped it, and it's been an extra $20 or $30 they've picked up there in the short run.
Well, speaking of technicals, getting a little more stock specific, and in fact, I was speaking with Dan Ice from Wedbush this morning, talking about he is seeing, well, he would normally say this anyway, given he's talking about tech, but sees a significant rally into year's end, particularly among big tech. I know you've taken a look at Apple and what's been happening to its stock recently.
Yeah, I mean, Andrew, there's every chance that we've seen the lows. We've just got to they're shedding headcount, a lot of these companies, so that's going to be solid for them moving forward over the next quarter or 2 quarters. So that's a good sign. I know it's a bad sign from a human resources standpoint, but from a balance sheet and what that does from a CFO, that could help lift these stocks and lift them a little bit further upside. So yes, there's every chance you're going to see a bounce to the upside for those particular markets. We've seen, as that chart demonstrates there, a nice rally to the upside, and we could have another leg up there in the short term. So don't stand in the way of a bull market at the moment. Some of those stocks are performing quite well.